All right, so I think it's time to get started. So thank you all for joining us this afternoon for our third annual Buy the Dip stock pitch competition. My name is Jeffrey, and I represent the Dartmouth Investment and Philanthropy Program, or DIPP. We were established in 2007 and are now Dartmouth's largest undergraduate finance organization, with over 300 members across all 4 class years. At our core, we are an investment fund managing around $900,000 of the Dartmouth endowment. But beyond that, we provide much of the pre-professional education on campus through hands-on investing experience and professional development events for our members. We were thrilled to see the extensive participation in our competition this year. So we had over 900 students from 93 schools around the world sign up for the event, with 210 teams eventually submitting a pitch. And our semifinalist teams came from everywhere in the United States, as well as the UK and Singapore. And finally, we organized a significant number of coffee chats between students and professionals at our 11 sponsor firms. We would like to thank all our participants for the fantastic work that you put into your submissions and hope that you enjoyed the experience. And today marks the end of the competition, so we will have 4 teams competing in our final round, as well as 4 teams comprised exclusively of freshmen who will be competing in a separate showcase round. We have $6,000 in cash prizes that will be distributed to these teams, and we're really excited to see what they've put together. But before that, we wanted to sincerely thank the many individuals and organizations who made this event possible. So to start, we want to thank the Magnuson Center for Entrepreneurship at Dartmouth, which serves students, faculty, and alumni at the school along their entrepreneurial journeys. So DIPP is an organization under the Magnuson umbrella, and we've benefited tremendously from their support. Specifically, we wanted to thank Sarah Morgan for her assistance coordinating with our corporate sponsors. Speaking of which, we would like to thank the 11 firms sponsoring our event: Advent, Apollo, Bancap, Blackstone, Citadel, CD&R, Fidelity, Hellman & Friedman, KKR, Silver Lake, and TPG. So whether it was contributing to our prize fund, helping to judge the pitches, or spending time speaking with students, this event would not have been possible without your support. And we would like to specifically thank our DIPP alumni and friends at these firms for working hard behind the scenes to help put these partnerships together. And we think it's a testament to the strength of the Dartmouth alumni network that we were able to bring these companies here in support of our competition. And finally, we would like to thank DIPP's Alumni Board, which is a network of former DIPP presidents who have continued to provide guidance to us as our organization continues to evolve and grow, including with this pitch competition and helping with arranging these sponsorships. So next, we would like to acknowledge the individuals who helped judge the semifinals of our competition last Sunday. So we would like to thank Asher, Brandon, Daivat, Jackson, Jared, Luis, Tim, Butsov, and Yizan for spending your Sunday afternoon with us. And we know that our semifinals participants really appreciated your insights and detailed feedback. And with many of you being involved with DIPP during your time at Dartmouth, we appreciate you continuing to give back to an organization like this. And on a personal note, I would like to thank everyone on the DIPP leadership team for helping coordinate the competition and judge the preliminary round on Sunday. Now, we would like to introduce the judges and participants for the final round of our competition. So joining us today as judges are Ben Rush, James Burton, and Kevin Frankfurt, who are actually reunited today after working together as part of DIPP during their time at Dartmouth several years ago. So we have Ben, who is a senior investment analyst at Viking, where he specializes in industrial transportation, aggregates, and building materials. Before Viking, Ben began his career at MS in the M&A division before moving on to investing roles at Warburg and High Sage Ventures. Ben graduated from Dartmouth in 2016 with degrees in math and economics, and he graduated from Stanford GSB in 2024. James is an investor at Sachem Head Capital Management, which is a value-oriented activist fund based in New York. James began his career at MS's M&A group and spent time with TPG in San Francisco before starting his job at Sachem Head. James graduated from Dartmouth in 2017 with degrees in CS and economics, and like Ben, was the president of DIPP during his time here. And finally, we have Kevin Frankfurt, who is an equity research analyst at Fidelity, where he manages the Fidelity Select Ledger portfolio and the Select Software and IT Services portfolio. Kevin has spent his career at Fidelity and covered software companies as an equity research associate before assuming his current role. Kevin earned his BA in Engineering Sciences and Economics from Dartmouth in 2015, where he was involved with DIPP as an investment committee member. So we'd like to thank Ben, James, and Kevin for your time, and we're really looking forward to the questions and feedback that you have for our teams. And we have 4 teams competing in the finals today. So the first to present will be Adi, Aiden, Akshat, and Zachary, who are sophomores and juniors at Duke University, pitching Establishment Labs. Next, we will have Andrew, Anita, Jason, and Sam, who are juniors and sophomores at Cornell, Queen's University, and the University of Chicago, who are pitching Cigna. And our third team presenting will be AirCap, pitching AirCap. They are Ben, Harry, and William, who are juniors and sophomores at Penn, U Chicago, and the University of St. Andrews, respectively. And last but not least, we have Matthew, Nathan, and Pierre from the Wharton School, who will be pitching Corteva. So, and these are the 4 teams chosen from our 210 submissions. So these are some very good pitches, and we're excited to see what they have when they're going to be presenting. So next, we'd like to introduce our freshman showcase judges and participants. So when we set up this competition a couple years ago, we recognized that there are plenty of very talented freshmen out there around the country, but who have only just started their journey with finance investing now that they've started college. And so the idea here is to give these individuals a chance to showcase their incredible work on an equal footing. And joining us as judges for the freshman round are a group of Dartmouth grads and DIPP alum from the class of 2024. So first we have Anay Saraf, who was DIPP president last year and is now an analyst in Rothschild's M&A group in New York. Next, we have Arnav Tolat, who was a member of the investment committee at DIPP and now works as a fundamental analyst for Citadel Securities in New York. Our third judge is David Moore, a former DIPP IC member who currently works in MS's Healthcare Investment Banking Group in New York. And finally, we have Rohan, an IC member who now works for Goldman Sachs' internal private equity arm in New York. So we'd like to thank Anay, Arnav, Dave, and Rohan for being here today. I've seen firsthand what you've done for the club, and we're really excited to hear your questions and comments for the teams. And lastly, we'd like to introduce the 4 teams presenting in our freshman showcase round. So first up, we have Jeff, Jiaxuan, and Rohan from Singapore Management University and the University of Oxford, respectively, who are pitching Peloton. And next, we have Adi, Mithun, Nayan, and Ryan from Dartmouth and NYU, who are pitching Micron. Third, we have Eric, Ayar, Luke, and Yashwin from Cornell, who are pitching Magnite. And finally, we have Anique, Jonah, and Kina from the University of Pennsylvania Wharton School, who are pitching Vestis. It's always exciting to see freshmen who are so passionate about investing. And thank you for your exceptional work on your pitches. And we're really excited to see you guys present today. So that brings the introduction to our competition to an end. We're just going to take a break before the first presentations begin at 2 p.m. Eastern time. So yeah, just please note that the final presentations are going to be happening in this Zoom room, so you can stay on for that, while the freshman showcase will be happening in a separate Zoom room. You can find the links to both of these in the email that we sent around earlier, as well as anytime on our website at dippnh.org/competition. Yeah, so with that, just see you again at 2 p.m.
And then with that, just to introduce yourself, so we are Team Silicon Valley Investors from Duke University. And as our name suggests, we'll be pitching a best-in-class breast implant company called Establishment Labs, or ticker ESTA. Yeah, so just to dive right into it, we think street and buy side is significantly misrepresenting the US commercialization upside, as well as international tailwinds, such as share acceleration, as well as pricing power. In our 5-year model, we underwrite around 24% IRR at an extremely skewed risk reward of just over 5.8 times. We think that the margin of safety has substantially improved following the recent resignation of ESTA's founder and CEO, which we think the transition was completely necessary in the markets currently overlooking the US launch upside, as well as pricing power and international market share acceleration. regards to where we derive our conviction from, we spoke to the CFO just last Friday to understand, the transition and what's really going on in the US right now. We conducted over 30 interviews with doctors from a diverse pool of surgeons, did channel checks across the value chain, talked to multiple experts, ran sentiment analysis, and recently we talked to a few long-only funds as well as a long-short fund to better understand positioning around the name and what really creates an incremental buyer into establishment labs. So in regards to where our variance is from, first is on the US commercialization. We think that the market's overlooking empirical trends and consumer demand, revision market dynamics, as well as incremental TAM upside. Secondly, we think there's margin expansion opportunity stemming from pricing power, maturity tailwinds, as well as a mix shift to higher average selling price premium markets on a business that already has high operating leverage. And finally, we think there's opportunity for market share acceleration stemming from the recent US FDA approval, as well as the opportunity in China.
Cool. So I'll walk us through the business overview. Right. ESTA is a Costa Rican medtech that manufactures and sells breast implants in 86 countries. Last year, they got approval for the Chinese market and received US FDA approval this past September. The majority of their revenue today comes from Europe and Latin America. However, we see this mix meaningfully change in the coming years. ESTA's breast implant Motiva makes up for the majority of their sales. And in addition to this, ESTA has pioneered a minimally invasive procedure, Mia Femtech, that we'll talk about later. So what makes Motiva different from other incumbents? Motiva performs an order of magnitude better than incumbents in reoperation, rupture, and capsular contracture. If we look at the bottom row of the table here, we see 10 years out from getting an implant, every product on the market has double-digit rates for complications except for Motiva. This is because Motiva has patented a nanotexture-based smooth implant that reduces inflammation and roughness.
And so to delineate our current investment opportunity, currently we have short interest at an all-time high above 20%. This is largely due to a disbelief in the commercialization story, specifically in the US, concerns over cash burn, and also a secular overhang that has led to some wonky destocking cycle comps. And as a result, this bearish market sentiment has created an attractive EV sales revenue point as multiples have compressed over 7 turns to current 7.4 times multiple. And additionally, over 2 weeks ago, we had the CEO, Juan Jose, actually step down. And this lent itself to over $300 million in enterprise value being wiped out. However, we spoke with CFO Raj Denhoy to get more color on this transition, and he described it to us as sort of a tactical transition to Peter Caldini, who is more operationally minded. And this fits well with a lot of the conversations we had with buy-side firms, including long-onlys, where prior to this event even happening, they had concerns over management's ability to scale what they thought was a very good and differentiated product. So as a result, we believe that the stocking cycle leading to easy comps, a trough-on-trough setup, and now a significant valuation discount lends itself to creating ESTA at a very good opportunity setup.
Yeah, so I think before we dive into the theses, it's helpful to just have an industry overview. So in the implant space, there's two major types of surgeries. The first is cosmetic, which just involves surgeries that change the shape, size, or texture of breasts. Note that not all of these surgeries actually require implants, and then Motiva implants already have FDA approval for this category. The second are reconstructive surgeries that are performed when medically necessary, so typically after some form of trauma, and these will almost always require an implant. Motiva implants are scheduled to receive FDA approval for this category in 2025. Now, I think one thing that we wanted to note about the industry is that when you're trying to estimate the TAM, it's actually quite challenging because while there's multiple plastic surgeon societies that publish operation data, there's oftentimes inconsistent industry reporting standards. And so it's difficult to pinpoint the actual number of implants that are required every single year. And as a result of that, if you look at sell-side models, there's actually significant discrepancies between their TAM bills. And so this is a point that we will revisit in Thesis 1. And then the final thing we just wanted to note about the industry is that historically it's been highly commoditized. As per the IQVIA MedTech survey, surgeons view incumbents as largely undifferentiated. But that same survey, the surgeons also state that Motiva's products are significantly safer compared to their competitors, and that patients have also indicated that they're willing to pay a premium for safety. And so we believe this signals an imminent industry upgrade cycle. Moving on to Thesis 1, really the main point here is that street and buy-side expectations are underestimating the US commercialization opportunity. So the current US narrative actually parallels ESTA's launch in Switzerland and South Korea, two luxury markets that are highly similar to the US. So in both these markets, sell-side and third parties initially underestimated Motiva's potential TAM penetration pre-launch. However, once ESTA's implants were actually introduced into these markets, not only were they able to sell them at a premium to competitors, but they were also the market leaders in less than 5 years, forcing incumbents out of the space. Note that one of the reasons for the rapid growth as well was because of the secondary revision market. So in this space, Motiva's competitive advantage in safety actually makes them dominant, in part because the end user base in this market typically skews towards higher end, safer products, in part because on average they have their ages are higher and they have higher income as well. Note that the US market has similar dynamics to South Korea, with the revisions market accounting for roughly 30% of TAM. Even with all of these similarities between the US and South Korea and Switzerland, we're still underwriting US growth at less than half the pace of South Korea. For instance, if Motiva reaches only 23% of market share in 5 years, the stock price will still more than double. We also have conviction in this growth due to several factors. Specifically, what we did was we did a conservative account build using quarter 4 numbers from ESTA and also data from competitor Sientra's launch within the US. Note as well at the time that Sientra had a materially worse product and a worse launch setup as well. And so we believe our assumptions are highly conservative. Beyond that, they're also grounded by our consumer demand research. Specifically, while Motiva is currently trending positive within the US, incumbents like Allergan are falling behind due to reasons like safety concerns being cited by users, and so the overall sentiment is negative. When you overlay this with the fact that ESTA is building out its US direct sales force and that they're poaching key talent from Allergan, we believe that Allergan is structurally weak within the US and that their market share is up for grabs. Finally, even if we're highly conservative with our market penetration assumptions, we still believe there's significant levers for long-term upside. For instance, due to the inconsistent industry reporting previously mentioned, sell-side models underestimate TAM. For instance, BTIG, which has the key analyst, one of the key or top analysts on the name, completely ignores the breast reconstruction submarket, which is a space where Motiva's competitive advantage in safety should lead it to win. To address this, we spoke to the research director at one of the leading plastic surgeon societies within the US, and as a result, we were able to develop a much more accurate TAM build out, where essentially we're taking data from these different data sets and we're looking at the appropriate line items to come up with a more accurate number. We were also more granular with our market penetration assumptions, breaking it out by operation subtype. As a result, we were able to develop a strong variant perspective in regards to US top line numbers.
Yeah, so on to thesis 2, we're extremely variant on a gross margin uplift from maturity tailwinds, pricing power, as well as a mix shift to premium markets that have higher average selling prices. In regards to the maturity tailwinds, we basically looked at initially discounted products and compared to long-term targets, and with some back of the envelope math, found around 20% uplift that we only conservatively apply to countries that Motiva is already mature in. In regards to pricing power, we did multiple interviews with doctors, one of which was with a South Korean doctor who noted seeing the cost per implant increasing, but seeing no reason to switch as a result of Motiva's strong value proposition. So remember, in markets where Motiva is able to get 60-70% market share and forces out other comparable incumbents such as Allergan, they're pretty much just left dealing with way worse products and could continue to increase prices in that sense and become very sticky. Secondly, we did channel checks with multiple doctors and found the ability for doctors to pass on price to end consumers due to the inelasticity of the breast implant market. And this especially was occurring in regards to developed markets. And this is extremely important as considering that they could continue to pass on price, we believe there's a lot of runway to continue to increase what the implants are selling for. And then finally, we're very variant in regards to top line beats on the US and China. And those are markets with some of the highest average selling prices, highest incremental margins. And as a result, a mix shift to those markets will lead to a significant uplift in regards to gross margins. And then on thesis 3, we believe the street is structurally undervaluing the China opportunity as well as the recent FDA approval. In regards to China, we've already seen headspace ramping and a lot of parallels to South Korea, which tends to be a trendsetter for the region. In regards to South Korea, the product did very well for a few reasons, such as the product being premium, being way safer, having, its viscoelasticity and also smaller incisions. And a lot of these factors are extremely valued in the China market. And considering that this is the first implant to be approved in China in over a decade, we truly believe it's disruptive and kind of have seen this through web traffic scrapes. Finally, in regards to FDA approval, we did multiple channel checks and found that a lot of doctors, the primary concerns of them and holding out was the fact that there was no FDA approval, especially in developed markets with higher average selling prices, such as in Europe. And this is confirmed by GLG surveys that found over 40% of doctors would be likely to switch to Motiva in the case in which they got FDA approval. So as a result, we pencil in a slight acceleration into 2025, and considering recent cyclicality and destocking cycle, we believe that there'll be easy comps, and this will lead to a lot of positive revision on the name.
Yeah. And outside of US commercialization, there are really three main debates that have maintained short interest at above 20% for the last few months, right? And I think the first one is about high cash burn. Bears argue that Motiva's cash burn signals looming liquidity crunch, drawing parallels to Sientra's recent bankruptcy. We counter this by saying that Sientra was had a distributor focused model and can reach EBITDA positivity by full year 25 and FCF positivity by full year 26. Additionally, higher SG&A as a percentage of revenue reflects an expanding direct sales model, which boosts near-term costs, but margins will be stronger in the long term. Lastly, recent revenue deceleration appears more cyclical than structural, given post-COVID demand shifts and temporary destocking. We see this normalizing in the near term.
So given our variant views, how do we actually make our money? We believe that as incremental US and China commercialization data prints come in, our variant view will actually be amplified, and a lot of the shorts will roll off and become the incremental buyers. And as a result, going into the next fiscal year, we would see that an earnings revision cycle and a strong beat race cadence will be established. Additionally, we do believe that Establishment Labs has a lot of embedded option-like upside through its potential to be a takeout candidate, as a lot of medtech companies have come out in 2025 and talked about their expansive budgets for M&A. Additionally, they do have a strong product suite, including a ramping Mia Femtech minimally invasive surgery process, and also a preserve platform that we believe not only adds to the incremental top line, but also contributes to a secular growth story where women who were not primarily, considering augmentation prior to these minimally invasive procedures are now actually considering them and actually will go to and either preserve or Mia Femtech. And then moving on to our valuation, we derive upside through three main levers. First of all, we have our international top line beats that are primarily due to FDA knockoff effects and also modeling China using a South Korea ramp curve at a conservative discount. Through both of these levers, we see around 23% and 16% variance to street numbers, respectively. Additionally, on the US commercialization story, we did a TAM build out where we saw significant upside through revision processes. And also we did a blended ramp curve between luxury markets, Switzerland and South Korea to derive over 60% variance to what the street currently has. This also was done modeling ASPs at a flat 1500, which we see as conservative in terms of a long-term view. And then finally, to model in our gross margin variance, as Zach mentioned, we do see maturity tailwinds in a lot of markets, luxury markets where discount roll-offs will lead to increased ASPs. And additionally, our mix shift towards luxury markets in the US and China, which should also provide a lift and in aggregate contribute to around 500 bips in gross margin variance. So in total, exiting at around a conservative 5 times EV revenue multiple, we underwrite around a 24% IRR at an extremely favorable risk reward skew of 5.8. And with that, we are now open to questions.
Yep, thanks, guys. Ben, James, Kevin, go ahead.
I'm happy to start.
Kevin, sorry, I think you're muted.
We can't hear you, Kevin.
All right, maybe Ben or well, Ben or James, maybe you start off then.
I guess maybe one of the questions that I would have when you think about like how much risk does it feel like there is with this sort of regulatory approval with the FDA? Like my sense when I hear this, it sounds like a great pitch. But when I think about this sort of binary FDA approval event and a lot of the thesis being dependent on sort of ramping in the US and like I think you described sort of knockoff ramping in China and elsewhere as well. Like what sort of work and conviction do you guys have on sort of the FDA approval coming and how should we think about what this could look like if the FDA approval doesn't come through, given obviously a lot of debt on the balance sheet relative to EBITDA and sort of the cash burn that the company's dealing with?
Yeah. So in regards to FD approval, like the primary augmentation actually occurred just last quarter. So that's where we do the primary variance and like kind of the ramp up. So we already have conviction on that. That's followed through. In regards to the reconstruction market, which is what we project out in 2027 in the US launch in regards to FD approval, I think we have a lot of conviction there in regards to talking to management, like working through the trials and also seeing how that exactly occurred in other international markets in the sense that reconstruction always has shortly followed after the primary augmentation. But in regards to kind of, answering your question, like it happened last quarter, I think in the case that you didn't have that binary like catalyst, it would be a completely different story.
Yeah, and I think to just add on, we think that ESTA is pretty well diversified, like geographically. They have a pretty big region in APAC ex China, additionally in Latin America, which are, typically less litigious environments, don't need as much regulatory approval. And in those mature markets, they've already gotten like enough regulatory approval. And so as a result, we believe that, those markets and kind of our underwriting assumptions won't be that impacted as much. And I think that a lot of the projections that we did in terms of upside to ex-US, ex-China markets and like FDA roll-off effects, weren't really a big needle mover in terms of our overall upside.
Makes sense. Thank you.
From a just from a product standpoint, I guess I'm kind of curious. Like it seems like the market in aggregate is not that large. It's like a $2 billion market globally, which I don't know. I don't know if you guys have the geographic breakdown of that, but what it seems like this probably is not like a product focus area for some of the incumbents, is the sense that I get. How technologically moated, or like what from like a pipeline standpoint from competitors is out there that we should like be aware of in terms of just like other competitive risks to this product?
Yeah.
And that you're like kind of taking like a singular, you're taking like a singular bet on something gaining adoption in new markets.
Yeah, no, that's definitely a really good question in regards to understanding like competitors and where they are from a pipeline perspective. Like Johnson & Johnson and Allergan, they're not investing in kind of new breast implants in the sense that they would have to spend a lot of money in order to just get an incrementally better product that couldn't see approval for up to a decade. And so it just doesn't make sense to invest in an industry with only, a $2 billion size and a competitor like Motiva, in which, if you were to innovate, maybe you only are incrementally better. Which is why we don't see other competitors trying to enter the space. And if you look at China, for example, Motiva is the first implant to be approved in over a decade. And as a result, you see kind of a relatively stronger moat here in the sense that their technology is very nuanced, but also you don't see other players willing to spend the money to try to capture a market. And considering Motiva has really high incremental margins and doesn't need to capture, as large of a volume as percentage of total TAM in order to break even, it makes sense to invest in that type of company that currently exists in the market, but you don't see other players trying to come in, and they're really the only large pure play company left.
And what is like the break even? I'm sure you guys have done the math on like what is the number of units or like the market share stat that you have to believe to get even on the cash burn piece? It sounds like they're ramping. I guess like I agree. It's a very interesting pitch. I think I guess the question is like if you're ramping up a direct sales force and you like the US business is not like we hope it will ramp, but we're not sure it will ramp.
Mm-hmm.
How much success do you have to underwrite to actually get to solve your cash burn problem?
Yeah.
While you're ramping the direct marketing spend.
Yeah, I definitely think that's like the core of the pitch here, and why we're so bullish here is you realistically only need around 10% share. And if you compare to Sientra, which is a way worse like product offering, they were able to get 50% share in just 3 years when they launched. And considering how we've tracked account growth, spend per account, as well as churn rates internationally, and if we extrapolate those over to the US, we underwrote very conservative numbers and access around 20%, of that share in the next few years. So, you could sensitize and the company breaks even under, double digits. And I think that kind of gives a lot of confidence in the product. And even if they don't launch successfully in the US, you still have this growth story ever internationally that could access that break even in regards to cash flow. And once you cross that, barrier, you're able to see, really high operating leverage, really high incremental margins that really adds to our conviction in the story.
Because someone else happened.
Can y'all hear me now? Great.
Yep.
You guys talked a lot about Switzerland and South Korea and the similarities between the US and those countries. Let's say that 5 years from now, they failed to take share in the US. What differences between the US and those countries do you think would explain why they may not have taken share if we were talking 5 years from now? Like, what are the key differences to be aware of?
Yeah, I definitely think in regards to launch strategy, through like South Korea and Switzerland, initially there was some, work through distributors, and then towards the end consumers, the way that management decides and is going about the US launch is direct. So you have a different setup there in the scenario of like S&M and that type of market. And I think that could definitely lend to a difference in kind of how many accounts they're able to reach. I think another detail to pay attention to is in regards to the US, it's an extremely litigious market. And considering you have smooth versus textured implants, and implants that have historically been textured have association with lymphoma. Although in this case with Motiva, you have nano textured, and none of the factors that actually lead to that lymphoma has been evidenced by trials. There might be some hesitancy in the US, which is a little bit more incrementally litigious in order to adopt the product. And I think that's probably the primary concern there.
Yeah, just to like quickly build on that, because we had a couple of calls with like some of just like leading KOLs within the space, and I think that was sort of like the primary differentiator that they talked about. Because I think in places like Europe, like in Switzerland as well, they're just a lot more sort of comfortable with the kind of textured implants, whereas in markets like the US, for example, it's something that's not as common, and so it would just be overcoming perhaps that sort of initial hesitancy that might explain one of the reasons why it might not be they might not be able to take share like they've done in these other situations.
I'm curious, what portion of the cost of one of these procedures is the implant? And who is the key decision? Like, are you selling to the doctor primarily or to the patient?
Mhm.
And to what extent do you need to establish? I think there are some like structural differences between the U.S. healthcare system and healthcare systems in other countries. And like, to what extent are there operational challenges that a company that is not based here, like doesn't have its origins here, like how confident are you that that their buyer will be receptive, I guess, to a product that is just like newer to this market, and yeah, I'm just curious.
Yeah, I definitely think you have all like the elements in regards to safety and consumer demand, all these factors. But I think in regards to like the price question you initially asked, so you sell directly to the doctors or distributors. In regards to the US launch, they're going to be trying to sell to doctors. And that kind of gives why the doctors would adopt it. First is like this, like the safety profile in regards to kind of the litigious nature to the industry. You're trying to minimize risk, minimize, the potential for anything related to medical malpractice. And then the second point there is when you have an end consumer that on average for Motiva is way more likely to request the product, especially in the revision market, that's going to lead to doctors adopting it as you get that kind of ask rate up. But yeah, generally you sell to the doctors for like $1,500 as is our average selling prices in the US. And then in regards to the operation cost, that could range anywhere from 5,000 to 12,000 to even 20,000 in places like New York City, or populated areas. And the reason why we have a lot of belief in the ability to enter with heightened prices and pricing power is these doctors can often just pass down that price to end consumers, because in the markets like US, you have someone who's relatively inelastic. They're willing to spend a few extra $100 to have a way safer product, which gives us a lot of conviction in the US, where you have end consumers who have more money.
I think just to add on to that, I think Motiva's done a really good job of aligning their operations to sort of a U.S. commercialization story. They've poached a lot of Allergan's key, like head of U.S. sales, and a lot of their key management leaders that help them with their market penetration in the U.S. And so I think because of that, you're seeing sort of the story and the belief from a lot of the KOLs that we talked to in the U.S. where they have confidence now that this can penetrate the U.S. markets, and you saw that especially after getting FDA approval. And I think incremental catalyst down the road with reconstruction approval as well would only kind of bolster that penetration as well.
Maybe one more from me here, but just when you think about the distribution of returns on downside and upside here, just given the balance sheet and given sort of the need to penetrate a couple of those new markets, how do you think about like downside absolute risk of what this could look like, and maybe sort of the near term 12 to 18 month potential downside versus sort of the 5-year base case IRR you underwrite when you think about like risk reward from your case versus what this could look like in the near term?
Yeah, So as we previously mentioned, like you get to break even with single digit numbers in the US. However, if you don't commercialize properly in the US, you're going to see 2027, 2028 still having that ability to break even considering the growth story in other countries. So in our bear case, we model in an apocalyptic scenario in which they fail US commercialization, average selling prices don't ramp up, and you kind of see that story with a lot of cyclical weakness persisting. And we're still able to see, at this point, only pricing into stock prices in like the 20s and have that really skewed risk reward. But generally considering, our base case and kind of the upside there, we think it's extremely asymmetric at this point.
Yeah, and I'll just add, like following, Juan Jose's step down as CEO a couple weeks ago, we think that the bull case has been severely de-risked. And what really needs to happen is just more commentary on management side in terms of informing the public like, kind of why this happened. Obviously, we had sort of a read through to that with our call with the CFO following Juan Jose's step down. But we think, at the next earnings call, we'll get some more commentary on sort of the transition to Peter Caldini as operator, and that will sort of install more confidence in the public in terms of their ability to penetrate these new markets, even with someone else at home.
I've got one more for you guys. What is your price target and how do you get there?
Yeah. So in regards to a price target, we're at around $97, $98. And the way to get there is around 20% market share in the US. We have that like mix shift incrementally to the higher average selling price markets, and then also ramping China share, and kind of continuing to see 200 bips expansion in international market share, which is kind of in line with acceleration we've mentioned previously, as well as international trends and kind of that long-term growth story. And we think like realistically, like at least doing the account build math, like in the US, like them adding, 7 to 8 accounts, taking very like conservative approaches to like churn, as well as, the way that they're pacing in terms of their current launch, that I feel like these numbers make a lot of sense and it gives us a lot of conviction, especially given the other drivers we mentioned previously.
And are you guys using a DCF or comp
Uh,
multiples, or how are you getting to 97, 50?
Yeah, so we just exit on our forward 2030 revenue number on a EV to revenue multiple, which in the med tech industry we saw was the standard.
And what's the multiple?
5 times, which is
Okay,
significantly below its long-term average, just considering the growth profile and the maturity of the company.
got it. Thank you.
All right. I think it's time to move on to the next team who are here, but thanks so much, guys, and that was fantastic.
Thanks, guys.
Thank you.
Hey,
Thank you.
Okay, so good afternoon. This is Anita, Andrew, Jason, and Sam, and today we are pitching Long Cigna. So first, Cigna is a managed care and healthcare service organization that specializes in commercial insurance markets as well as pharmacy services. Its core business is divided into 2 main sectors, Evernorth and Cigna Healthcare. Evernorth itself is also split into 2 segments. The first is pharmacy benefit services, basically the middleman between insurers and pharmacies. And the second is specialty and care services, or the managers of the high-cost specialty drugs and treatments. Cigna Healthcare administers health insurance plans for employers, individuals, and groups. So currently, approximately 76% of Cigna customers are under an employer-sponsored ASO plan, and the other 24% are under a self-insured, fully insured arrangement. So historically, Cigna has been a pretty consistent compounder, with EPS growing at low double digits every year. However, it currently trades at a discounted 9 times forward multiple due to recent pullback in managed care organizations. There are 3 main reasons that we believe Cigna is trading at this discount. The first is regulatory overhang surrounding potential PBM reform legislation. The second is Humana acquisition fears. And third is valuation pressure, as investors are favoring higher growth Medicare Advantage names. Cigna is currently trading at valuations similar to the 08-09 financial crisis, which we believe presents a significant re-rating opportunity. So we believe Cigna is the most attractive mean reversion pitch within the MCO space. If we take a look at the stock chart, Cigna's stock has faced significant pressure over the past 3 months. However, we believe that Cigna still presents a very compelling MCO opportunity, combining their normalization potential with low double-digit compounding growth and solid core fundamentals.
So just going into our thesis, we believe that there's been a perfect storm of misunderstood headwinds, the PBM bill, Trump's middleman comments, commercial MLR pressure, etc. And this has all led the MCO space to trade at trough multiples. We believe that that Cigna is a compelling investment opportunity due to two main points. First, PBM noise obstructing a de-risk story with limited downside, and second, Cigna being the best story in the MCO space to own, with reliable core compounding and pharma upside, along with capital allocation through buybacks. We recommend a long on Cigna with a 29 price target of $625 for a 19% IRR. Going into the recently introduced Hawley/Warren PBM bill, this has led the market to price the worst possible case for Cigna, but the most likely outcome is certain to be much fairer to Cigna. First, negative policymaker sentiment dramatically mischaracterizes the PBM industry, as greater than 95% of rebates are already passed through. Moreover, the government would have to replace the PBM as a middleman, which contradicts with the DOGE/small government ethos of the new administration. MA is also a much more attractive target for regulation than PBMs, with MA companies known to inflate sickness scores and cost several extra billions of dollars worth of money paid to insurers. Cigna is insulated from this risk due to the past divestiture of its MA business. And as you can see on the right, historical legislation has mainly been focused on transparency / addressing the pricing of niche PBM subsections, although they have still failed given political disunity. The slim majority / divisiveness in the new Congress limits the likelihood of the bill's passage. So what is the new PBM bill? Policymakers essentially have two goals: one, to lower drug prices, and two, to reduce PBM profits. And the new bill seems to achieve these goals specifically through three sections. Part 1, delinking Part D, 2, banning spread pricing in Medicaid, and 3, requiring a pass-through of 100% of rebates. These changes would result in significant premium hikes and higher pharma prices for customers, as PBMs currently are compensated based on how effectively they secure savings for customers, with a flat rate if Part D is delinked, reducing the incentive for them to negotiate better. We believe that Cigna's worst case is already reflected in the current trope price for the business. Even the downside is limited in the event of regulation, as a specialty biz is unlikely to be impacted, and also only a small percentage of Evernorth is exposed, with Cigna already mitigating these potential impacts by switching pricing mechanisms. We size the potential rebate impact on Cigna, which adds up to around $500 million, far from the terminal value tail risk that the market is extrapolating. As scrutiny and sentiment normalizes, we believe Cigna should experience mean reversion.
Our second thesis is that Cigna offers the investor a healthy balance between a stable core business and exposure to accelerating pharma tailwinds. First, I'll address the healthcare business. We believe that in the long term, commercial risk will price the trend. Our reasoning is that history has shown undercutting to win business is a losing strategy. The problem is that orgs cannot win enough business to offset the gross percent margin loss when they're already razor thin. So we think that the regulatory range post-ACA is a natural long-term equilibrium MLR for risk. Every point a business prices over this is pure margin hit. But this paradigm is sometimes sensitive to shock when we see consecutive years of high single-digit cost growth and pricing can't keep up. When this happens, names trade on depressed earnings bases due to temporarily compressed margins. And this presents opportunity for long-term investors who believe that orgs across the market will exit their losing contracts and pricing will stabilize over our investment horizon. This year, Cigna management has been diligent pricing and guiding to trend, which they will carry forward into 25. Therefore, we model mid 4% net premium growth on a mean reversion case, while our reverse DCF implies pricing with inflation, which doesn't make much economic sense.
Furthermore, the specialty and care services segment of Evernorth is currently experiencing rapid growth. So this is driven by two key factors. The first factor is biosimilar innovation. Since Evernorth's specialty business Accredo began to offer Humira biosimilars, its revenue has scaled by 10 times. And with Humira's market valued at 10 to 20 billion alone, biosimilars represent a very significant and growing share of the specialty drug market. Furthermore, 50% of the top 25 specialty drugs are losing exclusivity in the near term. This creates substantial opportunities for other biosimilars to enter the market and replace these branded drugs. This also creates a very scalable model for Accredo and thus Evernorth to capture specialty market share and drive sustainable revenue growth. The second factor is an overall increase in spending on specialty drugs in general. So specialty drugs now account for 55% of total pharma spending, up from 45% over the past 5 years. Furthermore, nearly 70% of all approved drugs in 2023 were specialty drugs. This reflects a secular market transition from traditional to specialty drugs. Specifically, key areas like immunology and oncology are projected to sustain growth rates of approximately 8%. And Cigna, a current market leader in the specialty market, is intentionally positioned to capture these high growth opportunities. Thus, we model 6% Evernorth segment growth, driven by a steady 3% growth in pharmacy benefit services and a higher 8% growth in specialty and care services, a pretty conservative projection given Evernorth's differentiated offerings.
Apologies for my connection. Can you hear me?
Yep.
Yep.
Okay, great. To complete the second thesis, a mid-single digit chunk of our return is driven by our view on sensible allocation. The narrative around this acquisition-heavy industry has been a roller coaster of sorts. In the past, buybacks have sent EPS compounding into low teens in a relatively mature business. Despite historical antitrust problems, there's been recent concern management would pursue a large, value-destructive merger. But the setup into 25 leads us to believe buybacks are the base case, which would catalyze credibility and could contribute to a re-rate. A few reasons for this. We've seen Cigna divesting adjacent businesses like MA and APAC benefits to focus on core competencies. In particular, the recent divestiture removes what observers thought would be their springboard into MA. We further believe Humana is unlikely because Cordani remembers the antitrust problems and has seen what his shareholders think about Humana. And furthermore, Humana is probably an unwilling seller for the foreseeable future. So our takeaway here is that management commentary shifting towards maximizing cash flow and deployment with a relative rate of return in mind. Cigna stands to pile enough cash to buy back high single-digit share count each year over our investment horizon. We think the market is rather skeptical on Cigna's intrinsic value basis, so we did a reverse DCF exercise to approximate what's priced in. In doing so, we kept the variable assumptions conservative, modeling sub 1% terminal exit, margin compression, and reinvestment over street. Here's a summary panel showing our differentiation from the reverse DCF. In pharma, the implied rate doesn't give Evernorth credit for strategic portfolio positioning, capturing spec pharma and care acceleration. In premiums, the implied growth is a near worst case inflation growth. Furthermore, Cigna does not get credit for cost normalization post-Centene contract implementation, on operating leverage with scale, or on efficiency levers in the implied case. So our takeaway here is that we think the current valuation sets a very low fundamental bar. Here's another way to visualize today's valuation. Currently, the price implies Cigna's overall multiple mix trading at trough. In our 20% upside base case, we model MLR pressure, but regulatory clarity and capital deployment drive a 2-turn re-rate to a still below average multiple. In our up case, MLR stabilization in the low 80s, mid-single digit pricing, and high single digit Evernorth growth with a 2.5-turn re-rate outputs 38% upside. The down case represents poor fundamental performance and a regulatory worst case, like a complete ban of current pricing schemes with no potential adaptation and/or forced pharmacy divestiture, causing the business to trade at a blended sub 8x. This outcome only solves the 27% downside, which suggests a solid margin of protection today.
Yeah, and shifting things to kind of a comps narrative, what you can notice here on the graph is that in the past, the market have really sold off MCOs during times of uncertainty, and it's kind of attributing complexity as a sense of danger. But we think that today's policy and fundamental overhang is temporary, and this graph kind of highlights a historical discount to the market. But once we look at kind of how Cigna trades at a discount to even its MCO peers, you kind of notice that not only does it trade at a discount to historic relative valuation, but also at a discount to peers despite business model resilience, premium margins, and premium EPS growth. And moving on to the next slide, kind of wrapping things up with our summarized sensitized return summary. We're getting a 20.5% base case IRR on conservative fundamentals and normalized expectations in terms of earning multiples by 2029. But kind of our event path to realization here and our catalyst path is that in the short term, we're going to see minor regulatory action as a PR win for legislators and kind of a clearing event for perceived tail risk and diluted policy focus. But as a longer term investor, we think that fundamental mean reversion, which is kind of the theme of this pitch, as well as the capital return credibility through those consistent share buybacks and the maintenance of earnings power, can kind of clear the market's short-term attention span and kind of converge our pitch's narrative and valuation. And that's why we're pitching Cigna as a long.
All right. Thanks, guys. And with that, we'll turn it over to our judges for any questions.
Can you maybe start by just talking a little bit about the relative business quality between Cigna and some of the other MCOs? I've spent a little bit of time looking at United Health Group before, and I know it trades at a multiple premium and has historically. Can you just talk a little bit about why that difference is and like how we should think about sort of the relative valuation disparity between Cigna and the others and what that reflects on sort of differences in quality or composition of business and how you guys think about that?
Sure. I can start off with this. This is an important question, so I'll spend a little time on it. So for MCOs, fundamentally, the competitive advantage is both local and national scale. Cigna is one of the big three PBMs and a top three commercial player in commercial risk and ASO as well. So at least in the core business lines competitively, we view Cigna as at the bare minimum lacking a competitive disadvantage because it's large enough to conduct favorable negotiations with counterparties and place competitive bids to win contracts, assuming a somewhat regulatory stable industry. So just to give a sense, on 22 surveys, localities are highly concentrated to the tune of 70%. So Cigna does benefit from, just like the other MCOs, from the established membership pool of sufficient size / providers joining network to gain access, sort of flywheel. Modeling wise, our enrollment assumptions in terms of share are not above population growth, so there's some conservatism baked in here too. And just to add color, according to a call with a former exec, there's so little differentiation on the rough numbers, at least among the big three, whether it's 1/3, 25%, they're going up or down just 1 or 3% either way, depending on how effective they're at managing their strategies and taking customers. So in a non-disruptive case, we believe that thinking about the inherent market growth and benchmarking close to that is not too far from the truth. So just to address the mix part of your question, we view MA with its secular tailwinds regarding outsourcing and demographics. It's attractive growth, but it's also the most competitive space because there we see the brutal competition with Aetna and Humana pricing under trend, but they'll probably end up cutting benefits and seeding enrollments. So all things considered on the relative set of opportunities, we view Cigna's strategy of sticking to core commercial risk, where it's a top 2 player with UNH, as value maximizing.
You guys
just quickly on that topic. Sorry, real quick, just before we get off it. It looks like just to touch on another player. It looks like CVS is, obviously another large player in the market. Like faster EPS growth and trades cheaper. So you guys made the comment early in your pitch that this was like the best way to play this. I'm just curious how you think about the trade-off there.
Yeah, so regarding CVS, believe they're more, I guess, managing a public services approach. So they play in a different market where United Healthcare is by far the most dominant player. And that's a particularly difficult market to gain share and capture the market growth in. Versus Cigna has chosen the relatively more stable but lower growth, typically mid-single digits, commercial market to specialize in. So that's why we view Cigna as a preferable risk reward just because of the relative predictability of the opportunity set.
I'm curious, you guys had on page 7 or slide 7, I think it was, some math around just sizing rebates and like what percent of sales rebates are for them. Um, and I understand this is where there's some attention right now from the government. Can you talk about what decremental margins for any loss of rebates would be? And just clarify, do you expect there to be any pressure on rebates, or given the structure of the market, are you arguing that there will be zero pressure and therefore decremental margins don't even matter?
Yeah, so I can go into a little bit on the margins side. Obviously, like there's been pressure on PBMs to increase like the rebate pass through to 100% versus 95% currently for like the big three players. And Cigna should be in like the higher end of that. So that's why like the sizing of the impact is around 500 million, really far from the tail risk that like the market is extrapolating, the general public, etc. And with Part D, which is like pricing mechanism that would have the most impact on Cigna when it comes to regulation, that actually has gone through before in the past where regulation has been proposed, but it's been shot down by like experts saying like this is going to cost billions of dollars to the actual system because there's no incentive for the PBMs to negotiate anymore. So if you attach like a very low probability of success when it comes to this passing in such a divided legislator as of like this administration.
And for the 500 million of rebates that they retain, let's say they lose a quarter of those, how much profit do you think they lose if they lose a quarter of those? Like, what is the margin, the decremental margin on that? Or I guess said another way, do you think that those dollars would those translate 1-to-1 hit to profit dollars, or are there some offsets where maybe they raise pricing elsewhere to offset some of the lower rebates?
Yeah, I think like even in the worst case scenario where you have like all of that $500 million flowing to like profit impact, like that's already like priced in into the current true price of the business. So we're not necessarily like worried about that. In reality, it's much less than that, like probably only like, I guess like a majority of that probably flows down to profit. But even then, like that 500 million is such a small portion of the tail risk that the market is currently baking it into stock.
Thank you.
What is your guys' I mean, because it sounds like Cigna has walked away, or at least said that they're walking away from this Humana deal. So it seems like the hangover in the stock is not explainable by that so much anymore. My question is like, what is the view that you guys think, what is the math that you guys think the market is doing to justify like the discount that Cigna trades at today? And what do you think is like the biggest flaw in the math that the market view seems to take?
Yeah, so maybe I can start this off. But when we looked at kind of the reverse DCF, we think that the market is mainly skeptical on kind of the intrinsic value or the terminal value bet. And then when we look at kind of, the implied growth rate for the Evernorth segment, it doesn't kind of give Cigna enough credit for portfolio positioning to kind of capture the opportunity in spec pharma and care. And then in premiums, the implied growth rate the market is implying is kind of a near worst case inflation growth. But we think that the takeaway here is just that the current valuation is setting a kind of a low fundamental bar. But when we looked at this from kind of our sum of the parts perspective, we think that, the multiple makes trading at trial. But with those implied growth rates, we think that's what that's what makes the math kind of work out for our like 29 price target.
Just to add on to that, I think part of it is just these overhang related stocks, whether it's litigation, whether it's like regulatory. When you try to solve the math on a rational stance, oftentimes they don't really make sense just putting in consensus numbers because of the public and media attention that we saw on UNH and the MCO industry back in December, Trump's middleman comments, as well as uncertainty over what the new administration and Congress is going to do regulatory wise. I think these are all sort of animal spirits fears that we see that result in the current trading price.
What do you think it takes to get folks sort of comfortable with the fact that the regulatory risk is what you guys believe? I guess if I look at the multiples during the Obama administration of the MCOs, those were obviously well under market for like, they were really penalized for like a 2-year period, but they were well under the market multiple for like 6 to 7 years. Obviously, the Medicare for All debate lasted a couple years, like this perfect storm. Like, how do you think about, obviously, if this gets resolved in 6 to 12 months when less toothy bill gets or doesn't get passed, like, is that enough, or could this be an issue for the next 3 years, if not more, given the administration's desire to cut waste out of the system and otherwise? Like, how do you think about the potential downside risk for just poor views on the MCO market over an extended period of time?
Sure, I can take this one. Could we go to the next slide? Sure. So, I think regarding multiple wise, our multiple exit assumptions are relatively unheroic. The 10-year average is around 12x earnings, and the period would include both, as you mentioned, business as usual multiples and slump multiples. So in the short term, we think that according to our, I guess, bucketing the major regulatory potential outcomes analysis, the transparency on spread pricing, this type of bill is a PR win for legislators, and is our base case. This could perhaps become a sort of clearing event that offers legislators their PR win without necessarily long-term harming the profitability track of the industry, and could remove some of the tail risk that the market is currently fearing. Longer term, I think fundamental performance, for example, pricing normalization, stable margins, continued capital return, because I think the market still fully doesn't believe that they're not going to go after Humana, because they made a pass last year, they made a pass again this year. But we believe that the setup, according to our second thesis, this time is materially different, and that's our variant view there. But given these things, as well as potential adaptation to alternative pricing mechanisms and business mix shift, we think that over the 3 to 5 year investment horizon, we find it likely that the business will adapt, these fears will get cleared, and the business is likely to trade at a median business as usual multiple.
Do you guys think the Express Scripts deal was a good deal? And why?
Directionally, I do think so. It makes sense given the larger picture of the vertically integrated healthcare space, because back then they were, I guess, too small to compete. 20 years ago, it was very hard to imagine the current setup with United Healthcare, CVS, and Cigna as some of the big giants. But I think overall consolidation has been a theme in this industry, and Cordani is a, I believe, tactical allocator. So I think that yes, it makes sense vertically, but it was also a longer term bet into capturing secular pharma tailwinds as well.
All right. Anyone have further questions or move on? All right, then. Yeah, I think we can move on to the next pitch. Great job, guys.
All right, great. So my name is Harry. I'm here with my friends Ben and William. we're looking to get long here in AerCap Holdings today. We've noticed since we've started covering the stock in November, there's been more positive commentary, and we're excited to share the thesis. So, William, can you introduce the company to the audience?
Of course. AerCap is the world's largest air lessor that trades at a depressed 8x earnings multiple. Very simply, AerCap makes money through its spread of rents on aircraft and its cost of capital. Air lessors sign contracts at fixed rates for periods of 5 to 10 years. They incrementally change the book as new contracts are signed. I'd like to discuss some business concepts here at a high level. Think of AerCap broadly as an airplane portfolio management company. AerCap optimizes between whether to buy and sell planes or lease planes at premiums into a hot market or secure long-term strategic contracts. Understanding where AerCap is important to absorbing our thesis. While most of the forward-year revenues are from the past 1 to 2 years of lease rates, future expectations of AerCap's cycle price into the multiple.
Thanks, William. We want to really emphasize here that AerCap is a portfolio management business that trades planes. In down cycles, they put assets on their balance sheet for cheap, and in up cycles, they cash out their portfolio above book. To set up our thesis, we will touch on AerCap's historical performance. During the COVID recovery leg, people bought the discounted stock with the thesis that travel would return to pre-pandemic levels and air leaser valuations would follow. People bought the stock after the GE Capital acquisition that expanded AerCap's fleet by 87%, betting on fleet liquidation above book value and simultaneous stock buybacks driving the price up. We believe the market today is mispricing massive inflections in lease data, along with an increasingly tight supply of aircraft from original equipment manufacturers, and that this represents significant upside. Now I'd like to hand things off to Harry to discuss the theses that will drive the lease uplift leg and justify our $135 price target.
Yeah, so I'm going to do some work on thesis concept here. Firstly, through thesis one, there's been a lot of discussion about the September IBA lease data release. And sort of if you do the math down through margins, it implies 25% upside to consensus. We think there's a pretty low hurdle for like a street to sort of converge to our estimates, and we identified 3 reasons why there's sort of hesitancy to adopt so much strength in lease uplifts. Secondly, there's been a lot of discussion about AerCap now that it trades at 1x book. An important part of AerCap's value proposition is sort of this, buying back shares below book value and selling assets above book value. And now that it's normalized, it's posed these tepid low double-digit return on equity. We make the claim that if you're willing to bet big on asset sale gains above market expectations, there's more juice in the algorithm, and this produces a similar return on equity profile to the GE thesis at a much cheaper multiple. Thirdly, we've done some work on these Russian insurance claims, and we see upside in the next year. And then fourthly, we sort of see all these theses converging towards this true book value per share, which we see as sort of like the true value of the equipment book at this point of where we are in the cycle. And this is sort of our stop loss or when to sell for the thesis. We think the stock can move 30-50% in the next year. And let's just get right into the thesis. So thesis 1 on the right, you can see an illustration of where lease uplifts have been moving. This implies we've done a blend because the majority of these moves have happened between Q1 23 and Q2 24. Because there's some delay of when contracts are booked and when revenue is recognized when people get their planes. It's really is going to end up being a blended rate between these 2 years, and we estimate a 27% uplift. It typically takes 6 to 2 years for these to bake in. Probably longer now given all the aerospace supply chain disorder. Running this through margins, doing simple napkin math here on the left, we get 25% upside to consensus numbers. So sort of, what needs to happen for AerCap to make the hurdle and for earnings estimates to revise? We sort of have a more technical reason initially. The order books for these things are divided between extension rates and new lease rates. In the past, usually these have been around 1/2 of the book. You know, in the next forward year, it's going to be 2/3 of the book is going to come on new lease rates. And extension rates typically would get signed at market, or sorry, at the previous contract, and then the revenue would get recognized immediately. But recently, there's a September TGIS call that goes into depth about how extension rates are now getting signed at the market rate, just because supply is so tight and lessors are demanding premium rates for extensions. And sort of more on the new lease rate side, further disorder in the supply chain for air lessors and just aerospace in general has been delaying basically the lag time between when contracts are scheduled and when revenue is recognized. We estimate this to be around 1 to 2 years now. Below, we sort of have an illustration of where lease rates are moving. And as you can see, there's been massive inflection in 23 and 24 that we expect to bake into forward year 2025 EPS. Secondly, we think the street sets a bogey on Boeing's recovery. We've done extensive conversations with people across the aerospace supply chain, including fleet managers and just aviation analysts and reporters. And we think it's sort of a consensus idea on the ground that people are going to continue to lease their planes into the later half of next year and into 26. This sort of provides protection to our extension rate estimates. But on new rates, we also sort of take this macro theme on a tighter supply into the next, into 2027 and possibly beyond. There's around 3,000 planes that need to get delivered just to return to 2018 levels, and this is less any growth beyond that. So we're fairly convicted on this idea, and also, this provides protection to the multiple, which we'll talk about later. Finally, AerCap, management here, these guys are they're guidance sandbaggers, and they've done this time and time again. They like to set expectations super low to the street. Gus likes to sit in the stock and buy back shares because buybacks are such a large value driver for the AerCap story. And then he likes to slowly and incrementally show the story to the street, right? And we anticipate something similar entering Q4 and the issuance of the 2025 guidance setup. So I'm going to talk a little bit about the multiple here and then hand this to Ben. People bought the stock in the past because he had this attractive arbitrage of buying back shares below book and selling planes above book. This produced a very attractive return on equity, and the multiple boosted up after the GE acquisition in anticipation of this thesis. But this hasn't really been happening anymore. AerCap has returned to this low double-digit return on equity, and just as price book has normalized to 1x. We look to frame this differently, and sort of the intuition behind this flywheel that we're proposing is important for thesis 2. Recently, last quarter, AerCap's been able to sell assets at 25 to 30% gain in sale, and this has been true for the past year. We believe charging these buybacks, this gain in sale right into buybacks, provides a similar return on equity profile to the GE thesis. But what's attractive about it is that you enter at a much cheaper multiple. And the reason why this exists sort of is all part of this mark-to-market idea that really sort of at a mark-to-market price book, this stock isn't at 1x book, it's much cheaper.
Thanks, Harry. So the aircraft resale market has been heating up in recent years as there's been increased travel demand, limited supply, and delays in new aircraft deliveries from original equipment manufacturers. Last quarter, AerCap reported gains on sale of 27%. The aircraft's going for 2 times book value in many cases. This is significantly higher than the 10 to 15% gains on sale AerCap has seen historically. We see these gains on sale as largely sustainable given the increased costs of new equipment. As you can see in the bottom, the producer price index for aircrafts has increased significantly over the last 6 years, and we see that trend continuing.
Yeah, so sort of where do we see that we're differentiated, and how do we make money on this idea? Again, if you sort of buy the idea, right, and understand that the business model that all these planes are marked are marked much cheaper than what they're actually worth in sort of the aerospace resale market, then you sort of that implies this continued 25% gain in sales, which charging right back into buybacks and filtering also some upside from these Russian insurance proceeds make this $2 billion annual buybacks number highly achievable. Against consensus return on equity, where we get to like a 4% delta, and that's also reflected in the multiple. In anticipation of the GE thesis, AerCap bid it up, around 11x, as people anticipated the flywheel and sort of the earnings power that proposition implies. But now the stock is below its median PE, and we're kind of looking to enter here as we're taking sort of this non-consensus view that when many believe that the capital recycling algorithm has run its course, we still see more torque into the next couple of years. So at a very bold case, we think AerCap can re-rate from its 9x forward to 10x, and which we expect to just be driven by this buyback algorithm. And I do want to stress as well, the re-rate isn't necessary for the thesis to work, but we sort of view the re-rate and our EPS target combined as providing a really compelling bull case in the stock.
So now on to the Russia thesis. AerCap may benefit somewhere around $3.5 billion in insurance claims. Essentially, Russia seized around 100 aircrafts and engines in 2022 as a response to sanctions levied against them during the Russia-Ukraine war. AerCap filed a claim for those losses that would amount to roughly $2 billion after tax. And based on AerCap's current shares outstanding, getting these claims would amount to $11 per share. Pretty significant when they're trading at $95 per share. Based on several similar insurance claims that we looked at for Air Lease and ESTA NBC, we see these gains as fairly likely to go through and these claims to be approved, which would add $11 per share. So the mark-to-market thesis. If you were to dump all of this book onto the market, current gains on sale indicate there would be significant upside to their current valuation. AerCap's own fleet is worth far more than its book value implies. If we were to mark AerCap's own fleet to market using a 25% gain on sale, which we see as reasonable given the 27% gain on sale last quarter, this combined with the insurance claims would represent a 75% upside to AerCap's current valuation. We see this as a good time to sell in the AerCap thesis. Theses 1, 2, and 3 would be realized at this point, and it's a great exit opportunity. Now I'm going to hand things back off to Harry to expand on our valuation methodology.
Yeah, so we're looking to sort of sum these theses together, and sort of piece by piece. On the left, we've got sort of this boogeyman case, where we're really looking to sit down and torture assumptions. Most of the downside we think, of where we could be wrong is going to come from the multiple sliding. You get a lot of protection on new lifts, sort of like new lease uplift, and most of your downside on the EPS is going to come from extension rate sliding. So, we assume that if extension rates fall and, the market, also just general rates fall and the market anticipates, lower uplifts in the future, then the multiple is going to slide. This 6.5x is almost like a near COVID level sentiment. So I think, what's nice about your downside sort of capped on the idea that really only extensions can go wrong on the backdrop of strong inflection of lease data. And the multiple is sort of where you could lose money if ever. And then, as far as our base case is just pricing in thesis 1, right? It's getting to that 1510 EPS target, throwing it on a multiple to get to, a 25% delta to consensus. This is just flowing through the lease rate assumptions through margins to get to that upside. And then, our bull case is we get the re-rate and we get the EPS, which is thesis 1 and 2 working together, and with a little bit of juice from the Russia impairments. And this produces, this attractive 3-to-1 risk reward. And then, the mark to market is sort of this, like, we view as like the sum of theses 1, 2, and 3 all working together to sort of achieve this true valuation of the book based on where we are in the aerospace cycle. So to meet time, I'm going to skip, some of the other risks, but the main one that we think is that, the street might not respect AerCap's earnings power. In the past, and sort of the tail end of previous 2015, 2016, that previous air lessor super cycle, AerCap sort of struggled to take the next leg up, like we're describing. And one thing that we state is like the environment right now is so different. One, you sort of have this extended inflation, which makes all their assets written down on balance sheet really cheap. Secondly, you just didn't have up-lease inflection like you do today. And then thirdly, like people just weren't bidding up for old planes like they are now. So we kind of just look differently at the macro on that. And then just as far as our event path, we're excited about next quarter, and we expect the 2025 guide to provide juice. And then we just think continued EPS revisions and then buybacks, sales, and uplifts drive us towards that true book value per share when we look to sell. So that's the thesis, and we appreciate everybody listening, and we're excited to field any questions from the judges.
Awesome. Thanks, guys. I'll jump in with one quickly. And this might be a dumb question, but when you think about the risks here, like the aircraft supply risk, the extension rate risk, and like the risk, I guess, that the inflection in lease rates doesn't sustain, like, can you talk about how either correlated or not all of those risks are? And maybe my naive guess would be that if the supply fixes on the Boeing side, like maybe all of those risks sort of play out at once and they're very correlated, and that's sort of the biggest singular bet you're making, but I could be totally wrong on that. So I'd be curious if you could talk about, like, are those risks all correlated to a supply event, or are the extension and the lease inflection sort of separate risks from a supply event, if that makes sense?
Yeah, of course. So the way that we like framework how much the backdrop kind of matters to the thesis is above, like, sort of in this thesis one idea on the inflections, like all of these rates have already happened. These are contracts that would have already been booked, and the only thing that really needs to happen for these rates to show up in four-year estimates is basically for people to receive their planes. So on new lease uplifts, we think this sort of has little to do with like future expectations about like when people, about sort of like the air lesser macro backdrop. Where there is going to be like some setup is with these extensions, because extensions, revenue is just going to get recognized right away as the extension contracts are signed. So if you're signing extensions in the later half of the next year, and maybe there's some type of supply normalization, that's where you're going to get downside, specifically on our EPS. And then as far as like how tied it is to the multiple, and like is this like sort of like a singular risk, like what's their protection? Again, where we see like most of the downside is like if there's a chance like Street doesn't really respect this buyback story, if sort of the supply tightness wears off a little bit, and that's where you see downside to the multiple. But I do want to return to like this idea, which it's not like these guys are sort of just like fully vulnerable to lease rates falling off. A lot of what is sort of part of like the portfolio management equation of an air lessor is they also turn around to have different business partners and target strategic longer contracts to control the down cycle. Right now they're bidding up leases with Deltas, Uniteds. We're all very competitive. They all lease between each other. They're willing to pay up, but sort of the risk that comes with that is like that's just a much more competitive market and more of an elevator down. What they've done in the past, and this is sort of just part of the having trust in management, is like they turn to more strategic partners where you're going to be getting, instead of 6-7 year contracts, you're signing like 10-15 year contracts at rates that are like semi-attractive, that control downside and sort of like smooth out the way down for AerCap. If that sort of makes sense about like how the company mitigates risks on a supply normalization.
How are they financing the planes? Like, what is the capital, the source of capital that's used to actually buy the planes?
Yeah, I mean, this is a pretty levered company. It's around like a 2/3 debt, 1/3 equity. And a lot of that is because when they acquire these planes, like they to get GE and all that sort of thing, they they had to lever up to make those acquisitions, and that's sort of what they do in the down cycle. And part of that also is what provides such dynamic gain on sale, is that like you're you're sort of marking these down then, getting more strategic and taking out more financing just to get them on the balance sheet and then selling them at large premiums once the market heats up.
And like what's roughly their cost of debt?
It's around 10%. I think yeah, 10%.
Okay. And then the return, what's the return on the assets? Like you guys put some of the ROE stuff in here, but what's the return on the assets look like today versus pre-COVID? And if the returns get good enough, why wouldn't the airlines do more of this themselves?
Yeah, so that's a good question. I want to answer it in two ways. Typically this thing does like low double-digit return on equity in sort of like the run rate like normalized cycle, which is sort of like what people are anticipating now that the stock has normalized. One thing I will say on like why air lessors don't do it themselves, it's we had a chart in this in the deck, but we didn't have space to include it. But the global sort of like fleet of airplanes as leased planes have increased from like at like a 7% CAGR over the past 15 years. Like it's been a growing trend for a lot of carriers to just lease planes because it's easier. It's sort of it makes sense to have people sort of like in this like portfolio management seat of planes just because like people like Gus who run AirCap, like it's they spend all their time trying to time the market on these planes, and like that's very much a specialized job for people to do. And it and many times it's value accretive for airlines to do that. So that's sort of just been like where global fleets have going is people have just started leasing more and more. And this isn't something that's actually characteristic of like where we are in the cycle. Sort of if you like draw a line through the down cycle and the up cycle, lessors are just a bigger part of the global aircraft fleet in general.
Yeah, and just to tack onto that, Air Lease had in their most recent filing 20 years ago, 15% of global fleets were leased planes, and now it's over 50%.
I have a question for you guys. The thesis here, basically, like very simplistically, is basically that the asset doesn't actually trade at one-time book. You guys think it trades at less than one-time book because the assets are worth more than people think. And I guess my question is, does that assume, like if you're assuming some heightened gain on sale on like the whole book, basically, does that implicitly assume that there's like no normalization in the supply dynamic ever? Because like the company isn't going to turn around and liquidate the entire asset base at some heightened, gain on sale level. And so I guess, is it appropriate to be capitalizing the whole book at some heightened level as opposed to thinking of it as some one-off benefit? How do you guys think about that?
Yeah.
The math?
So I think there's sort of two ways that I want to answer this. The first is this is sort of not like, this isn't really like a valuation case for us. Like we kind of wanted to kind of show like at like a very like bullish like sort of like if we can sort of like frame where this is in the cycle, like what does that look like? And this price target too is less like any additional buybacks or things like that. But this wasn't sort of in the like bear base bull spread for us just because we kind of wanted to like frame what that looks like. I mean, what's more realistic and what we're looking at price in sort of in our base case is like a lot of your movement is going to come from like them capitalizing maybe like a quarter of their book through this gain on sale algorithm. And funneling that into buybacks gives you some upside. Yeah, so like I do want to stress this is very much like a mental exercise and sort of understanding where we are in the cycle versus like sort of a sensitivity case that we think seriously about. The second thing too is like on the gains of sale and like if we think that's like something that's at least like sustainable for let's say like a quarter to 50% of the fleet. recent, from recent earnings, like a lot of the planes they've been selling have been fairly old too. So, there's sort of this argument to be made as well that like what do gain on sale look like, for like a sort of like a mid-age assets that they have. It could be higher. But like the idea with this slide isn't to be like sort of we think this is going to happen. It's sort of like a sensitivity case. Like right now, like how much room does the stock have to breathe based on where it is in the cycle? Because a lot of people have been arguing that sort of AerCap trades at parity now that it's at 1x book, and we just sort of want to show like the additional torque that could be possible, even if not nearly all of it would get captured in our base case.
And then it's helpful. And then what it seems like there's a little bit of like airline, like some pullback, especially on like the low cost carriers. To what extent is I don't know what the customer base looks like, but if you do have some of these lower cost carriers pulling back, is that a meaningful headwind at some point to lease rates or not? And how exposed are these guys?
Yeah, we've done a little bit of work across the supply chain, and this is sort of like a question we get is sort of like, what is like, what are like the LCCs? What does that mean? What are the different type of carriers, and how does that respond to what these guys deal with? I mean, like, I do think like it's important to sort of understand like what the variety of people these guys are leasing to. Like, like that's sort of part of the equation, but like there's like there really is like beyond just like LCCs, there's so many different types of carriers internationally that are using these guys' planes, right? And at least like we don't really think like any like specific like pullback in a specific area of the aerospace supply chain is like would cause any sort of like material risk. Another thing too is like these contracts get fairly locked. We didn't do too much work on like what happens like if somebody like doesn't pay a contract. But I think like my point here is like there is like a very large and diversified network of who's leasing these planes.
With the point on lease rate uplifts coming through, sort of the data that implies that'll happen, and then maybe the cycling of that comes into the numbers that's ahead of consensus. Historically, and I'm guessing that there have been periods in history where this has happened before, where the lease rates accelerate, you sort of being more on top of the numbers, expect that'll come into the actual numbers. Consensus hasn't underwritten that yet. If there are sort of past cycles where this has happened, like how has the stock price reacted? Does it pull a lot of that forward, and that's already in sort of the street's view of numbers, even if it's not in the sell side numbers? Or how does the stock typically trade around like inflections in lease rate uplifts, if there's any sort of precedent periods where that's happened?
Yeah, the best example would be the 2015 to 2016 sort of there was like a similar like air lesser super cycle, so to speak. And in other words, supply got really tight again. And the stock actually bid up on a similar type of thesis entering it. AerCap was a great buy like into that 2015 sort of leg up for the lessers. And a lot of the sort of the thesis and for AerCap came from this sort of like earnings revision idea, like through uplifts, like uplifts inflected. There was a little bit of delay, and then they hit the books, and then sort of everybody, consensus estimates moved. So we sort of do think it's similar to that, but I think the one difference is like we're very much like giving a next leg up thesis. Air lessers were fairly depressed previous to that. And sort of the thing that we're trying to piece together here is like there's been so much focus on AerCap about the buyback algorithm, the GE acquisition. That's sort of that lease uplift story that was so important to like the entering that 2015, 2016 super cycle isn't something that's like there's been a lot of work that's done on it. And also like it's just been a story in the past that typically can take a little bit to bake into forwards. As far as like buy side perspective, we've talked to a few people, and we know like a lot of people just own the stock for the GE flywheel, and like that's sort of like was a large bulk of like of how people sort of like were reviewing the thesis, and like a lot of people kind of cut it off once that was over. You know, but we've also like talked to people about the IBA stuff, and you know, we've met people that that like are either like selling because GE is over, or they're getting excited about the stock entering the inflection. So like, you know, I think there's like obviously like there's, I'm not like saying like we're the only people to see this, but there's like sort of mixed views because we're sort of at a regime shift for where you are in the AirCap thesis.
Makes sense. Thank you.
I've got a quick one while we're on this slide. Why do you use a 31% margin at the bottom left here to get to $15 of earnings? That looks like it was the peak margin back from the 2010s.
Yeah, we just, because one thing to consider too is like we compared it to similar times of lease strength to where it is now. Like it's hard to compare margins on price over the past like 2 or 3 years because lease rates have been so low. We basically just captured a time when lease rates were high and tried to see like what that implied in the margin. So that's how we approach model. Like that's how we approach margins, is like we wanted to see specifically what like what this thing did based on where rates were in the past, because most of your uplift here is going to come from like pricing, right? But that was why we modeled that.
Got it. Thanks.
Okay, well, it looks like we're at time. But yeah, thank you so much, guys. Great job.
Hi, my name is Pierre. Today we're presenting Corteva. We have a long recommendation with 42.1% upside and 21.4% IRR. So Corteva is the largest producer of seeds and fourth largest producer of crop protection chemicals worldwide. Currently, 45% of revenue comes from crop protection and 55% comes from seed sales. Next slide. Agri-sciences is an industry with very high barriers to entry. Before jumping into the value chain, it's important to understand the two components of a seed, which are germplasms and traits. All seeds have a germplasm, which determines the yield of a crop, and traits, which determine resistance to a specific herbicide. Creating a germplasm is very complex. This requires billions of dollars and hundreds of years of artificial selection and scientific advancements. And furthermore, both Bayer and Corteva have specific traits which allow their seeds to be resistant to targeted herbicides. So for Bayer, their seeds are resistant to the herbicide dicamba, and Corteva seeds Enlist are resistant to the herbicide 2,4-D. Onto the value chain, creating a seed takes 4 steps. Firstly, Corteva must genetically modify their seeds with traits and germplasms. Then they must pay growers to produce the seeds a season in advance, as you can't produce the seeds on demand like on an assembly line. And thirdly, Corteva then stores these seeds for a full year and then sells them to farmers to grow the crops, and this usually occurs in the first quarter of a given year. Because of the necessary scientific and distribution barriers to entry, the industry has been structurally oligopolistic for a while, with Bayer and Corteva taking up roughly 70% of the market share. So we believe, the next slide, that Corteva is a secular winner that's obfuscated by temporary headwinds. Over the last 2 years, the company faced crop protection destocking and commodity deflation, which caused it to trade downwards. However, it has since recovered and remained relatively stable since 2023. And one thing I want to note here is that 16 of the 17 questions in the Q2 earnings call focused purely on crop protection volumes and pricing. We are variant on the other segment, which is the seed segment, and we believe Street is currently missing it.
We believe Corteva will generate 22% IRR until 2027 and beat Street 26 and 27 revenue guidance by roughly 20%. Firstly, we see significant gain within US soybean coming from dicamba ban, which I will discuss in our first thesis, leading to a 14% delta to 27 Street revenue. Secondly, we believe international farmland acreage growth is projected to grow significantly more than Street expectations, which Nathan will describe in our second thesis, leading to around a 6% delta to 27 revenue. Finally, we believe Street is modeling commodity significant margin uplifts in our model. Overall, Corteva is an opportunity to own an A+ business with many competitive advantages. As Pierre mentioned, their seeds, germplasm, and traits resistance are a result of the seed's 100-year breeding history. So a competitor with even $100 billion in capital will not be able to imitate their seed. Furthermore, they have significant pricing power and highly reoccurring revenue due to a toll road effect, where seeds are mission critical for farmers and solely dictate their yields, but are a small percentage of their cost base. Our first bet, next slide, please. Our first bet is that Corteva will gain share within U.S. soybeans. Last year, the U.S. District Court in Arizona banned the use of the herbicide dicamba because it causes farm drift, which means that dicamba travels to neighboring farms and kills their crops. As Pierre explained earlier, a seed is bred to become resistant to a specific herbicide. In this case, Bayer's seed Extend was bred to become resistant to dicamba, and Corteva's Enlist seed is resistant to 2,4-D. Since dicamba is banned, it can no longer be used, and farmers must use the only alternative in the market, which is 2,4-D. Therefore, farmers must switch to Corteva's Enlist seed, which is resistant to 2,4-D. Because of this, we modeled in 70% seed penetration by fiscal year 2027. Comparatively, the street is modeling no further penetration gains at 65%. And most of their revenue growth is mainly from low single-digit percentage price increases. And they are missing this dynamic for two main reasons. The first is that the focus on crop protection. Most of the sell-side questions in earnings calls focus purely on crop protection, and only one of 12 equity research reports even mentioned dicamba. We called sell-side analysts, and they verified with us that buy-side investors are also focusing on crop protection. Furthermore, we believe that management is sandbagging. In the Q3 call last November and at the investor day, they didn't even mention the dicamba ban at all. We called investor relations, and they said that they don't dial in any impact to the dicamba ban due to uncertainty on the share gain, which we feel differentiated in. So we believe this thesis will hit in Q1 of this year as farmers stock up for the next planting season. Next slide.
Yeah, now moving on to thesis 2. We believe there's an underappreciated international growth opportunity for Corteva. So just for some background, currently the streak really lacks visibility into the LATAM growth numbers, as data points on acreage growth are very scarce within LATAM. Looking through sell-side reports, we see that sell-side extrapolates U.S. acreage growth, which is about 1.5%, to the international market. And this is not really accurate. Using a geomapping software and database, we were able to kind of parse individual territories within Brazil and Argentina and track the exact farmland growth and change from 2019 to present time. And we see that currently Brazil's soybean farmlands is growing at about 12% CAGR, and then Argentina is growing about 9% CAGR, which is a significant delta to the current streets extrapolated 1.5%. And then on top of this, the historical Monsanto monopoly within LATAM is slowly fading away, as currently in the past 10 or 15 years, glyphosate has been the main dominant herbicide within the region. However, as we all know, weeds become resistant to herbicides very quickly, and currently 92% of weeds within LATAM have become resistant to glyphosate and are no longer effective against, and glyphosate is no longer against these weeds. So therefore, farmers now have to switch towards a dual-acting herbicide, which is either dicamba or 2,4-D. However, most importantly, as Matthew mentioned before, dicamba suffers from drift within the U.S., right? This is further exacerbated within LATAM region because of the humidity as well as the temperature. Calling experts as well as talking to the sell side, they really emphasized that the warmer, more humid temperatures within LATAM have really exacerbated the dangerous nature of dicamba drift, and it's even worse in these hot regions. And this is very obvious by looking at filings through the Brazil Ministry of Agriculture. We can see that even the government believes that dicamba is very dangerous, and within their filings and within their regulatory approval process, they've claimed that dicamba is very dangerous to the environment. So to conclude this thesis point, with Roundup nearing the end of its product cycle, as well as the increased dicamba drift within LATAM, we see Enlist gaining share, and we underwrite about a 30% market share in Brazil, as well as 10% market share in Argentina by 2030. So for thesis 1 and 2, all you need to believe is that one, farmers within LATAM will not use an ineffective product like dicamba, and two, farmers within the US will not break federal law against the ban and use dicamba. Now moving on to thesis 3. This thesis plays with the deflation and the commodity prices coming down since COVID. So for some background, corn and soybean prices were at all-time high during 2022 due to COVID supply chain issues, where supply was heavily dwindled because of the Chinese production of soybeans. Therefore, prices skyrocketed to levels that have never been seen before. And currently, prices have been falling and has fallen about 50% since the all-time highs. So with these falling prices, as well as the FIFO accounting system that Corteva uses, we see significant mismodel upside from the margin expansion component, which is one driven by management's reluctance to disclose real numbers on the upside, as well as just a lazy street modeling of COGS. However, we took a more in-depth approach by calling industry experts as well as talking to IR. We looked into the nuances of not only the commodity hedging policy that Corteva uses, but also the production cycle that Pierre mentioned of paying farmers to grow the seeds a year in advance. So after combining these two components, we see that currently only 2.5% of the current commodity tied COGS is at current prices. 40% were at last year's prices. 47.5% were at 2 year ago prices, and then 10% were at 3 year ago prices, right? So knowing this and knowing that prices have fallen dramatically since 2022, there's significant upside from margin expansion that has not been baked in by sell side or street. So therefore, we see about a 350 bips delta in 2026 and about 200 bips delta in 2027.
Beyond that, the street is also fearful of crop protection volumes and pricing, as well as the impact of reduced farmer incomes due to commodity deflation on Corteva's ability to take price on their seeds. Firstly, on crop protection, it historically grew mid-single digits, but during COVID, it grew artificially by 15 to 20% as farmers switched to Corteva's crop protection chemicals when China struggled to supply the market due to lockdowns. China usually represents 50% market share. There were also higher crop prices, which incentivized farmers to apply more herbicide and provided Corteva more runway to raise prices. Volumes also increased from farmers stocking up herbicide to maximize yield given high crop prices during the period. We believe, however, that inventory has been destocked and price-sensitive farmers using Chinese crops have already churned out. We expect low single-digit price and mid-single-digit volume growth to normalize by H2 24. Last quarter, Q3, marked the second consecutive quarter of positive growth in this segment. So we believe crop protection is de-risked. In terms of seed pricing, case studies with DuPont and Monsanto revealed that they historically took on positive pricing even during periods of commodity deflation. Seeds are mission critical for farmers, and analyzing seed costs as a percentage of farmer revenues also reveals that Corteva has runway to take price. We are in line with street in our base case, plus low single digits for the crop protection segment and plus low single digits for seed pricing, which generates a 22% IRR. But even in a bear case, we projecting negative low single digit growth for crop protection and negative low single digit growth on seed pricing. We still generate a 17.5% IRR, which drives confidence in our downside.
Yeah, moving on to valuation, we predict that revenues will grow at a 6% CAGR and free cash flow will compound at 11.4%, mainly due to the significant margin expansion coming from the COGS deflation. And then furthermore, moving on to our return analysis, we're using 11.8x exit multiple in 2027, which gives us an IRR of 21.4%. And then 13% of this IRR is coming from our thesis points and our differentiation on that. So moving on, we sensitize WACC and exit multiple for our downside case. And most importantly here, I think I want to emphasize is what Matthew mentioned. Even if we see low single digit decline in pricing as well as crop protection, we still have 31% upside. And this is relatively consistent over our 3 thesis points. For the bottom left corner, even if we have very minimal soybean capture from Bayer and very minimal LATAM growth, we still have upside from our other thesis points, which overall reinforce a picture of the downside case is relatively de-risked for our pitch.
So on to risks. We think the main risk is that Monsanto will launch a new variant of soybean products which are resistant to 2,4-D. However, they've already delayed this launch till 27, and we don't think it'll be very impactful for our financial projections, as we think it'll take even longer to implement. Another risk that Corteva is exposed to the agriculture cycle and commodity deflation. However, looking at past data, we've seen that crop protection chemicals and seed volumes are relatively inelastic even during downturns. And finally, the short stature and corn risk is also mitigated by the fact that it takes a long time to implement, as it requires fully different farming techniques for farmers. So once again, similar to the first risk, we don't think it's financially impactful. Onto the catalyst, we think the first major catalyst is that the COGS margin benefit will hit the income statement by 2026 because of delayed FIFO accounting, which will lead to an earnings beat. Secondly, I think the most important catalyst here is that farmers will start restocking in Q1 of this year, which will really showcase the market share gain from Bayer and ultimately lead to an earnings beat. And there's also a more long-term catalyst that we see, such as a better Enlist E3 product, further crop protection recovery in the market, and also further legal troubles for Bayer, which we believe will lead to larger market share gain. Thank you so much for listening to our presentation today, and we're very excited to take any questions available.
Hey guys.
I guess one like, oh, go ahead, Jonathan.
Sure. Thanks for doing this. I'm just curious, the Arizona ruling, how much does that matter? Like, is that just in Arizona that impacts the market, or is that a nationwide US dynamic? Like, as you think of the market share gains resulting from that, how big is Arizona in the market for these seeds, and what's the applicability of that ruling more broadly?
Yeah, I think
I actually had almost an identical question, but just to add on to it, is this like set in stone? Is there like some appeals process that means that this is just like a non-factor for Monsanto? Sorry, can you touch on those?
Yeah. To go off that point, it's actually the district court in Arizona. So it's not a state court, it's the US district court within Arizona. So it is a nationwide ban. For some context behind this ban, in 2020, Trump issued an executive order that actually banned dicamba. That order was actually overturned just because of the way it was like some legal issue with implementing the ban through an executive order that was deemed unconstitutional. So that was struck down. This ban is another reiteration of that similar sentiment from the administration. And there currently has been no appeal. I think Bayer is trying to get this through an appeals court, but nothing has really happened since February 2024. There hasn't been any really movement on softening the ban on dicamba. So it's going to be a pretty substantial nationwide impact for Bayer, just because it's been a long time in the making. It's been 4 years, and this is probably like the final moment for dicamba.
Got it. Thanks.
And can you talk about, like, in the event that the ban holds, if there are differences versus the prior iteration of this issue, what is the timeline and the progress that Bayer's made on the 2,4-D introduction? And what, if you think about kind of like a downside scenario, what does that look like from a timing standpoint, and what is the impact to numbers in your guys' view?
Yeah, so on the ban specifically, we don't think it's going to be overturned anytime soon. And then on the topic of Bayer developing a 2,4-D alternative, it's just one very, very tricky to use to just develop a new product and release it outside. Bayer has said that they were going to initially release their 2,4-D alternative for soybeans in 2025. They delayed it to 2027. And much of the reason is just because how hard it is to, one, integrate a new trait into the germplasm and not have side effects. Because there are millions of genes within soybeans. It's a very complicated organism. A lot of side effects with certain chemicals that are being introduced that could cause unforeseen side effects. So one, it's just one, very hard to make sure it's safe, and two, I think arguably most importantly is just like the yield side, right? Since farmers care mostly about yield, if you are going to release a product into the marketplace that has a less, a worse yield than Corteva, there really is no point to release it. And like achieving that optimal yield for Monsanto and Bayer is probably the hardest thing to do, because when they actually produce a 2,4-D crop, they have to license it from Corteva, and then Corteva has made it very specific, made very clear that they will only give like an older version of the trait to other competitors. So naturally, they're just at a disadvantage on the yield. So that's why it's been taking such a long time to push out a real competitor to 2,4-D and to Corteva's Enlist. And in terms of the number, if it does come out in 2027, we should see maybe 10% market share lost to Bayer. But within our investment horizon, we don't really see that panning out and being too material.
How meaningful is the crop protection market to their profitability, and do you have strong views there?
Crop protection is around 50% of their revenue, and we are not differentiated in any way to crop protection. We just sensitize our assumptions. For Q2 and Q3, it showed positive volume growth and positive pricing growth for the first time. And Street is expecting that as well in their models, and we put the same numbers in our models. But even if it were to go negative, we think that there's still significant returns. Our downside case with both negative crop protection growth and negative seed pricing still generates a 17.5% IRR.
Can you explain the downside math a little bit? Because it seems the difference between +2 and -3 in businesses of this nature on both pricing and crop, it would seem to me that if you have -3 crop protection growth and -3 seed pricing, I'd be shocked if the stock is still up 30% instead of up 40. I think on the last time, just looking at the sensitivities that you guys have. What is I guess, how do you explain the lack of sensitivity in your price target to the sensitivity in results?
Yeah, so I think here a main factor is Corteva has a lot of other segments, right? Seed pricing only, I think seeds make up about only like 40% of the revenue base. Crop protection is the other portion of it. And like within those other segments, there's a lot of other drivers, a lot of value creation drivers that exist to be pulled. And especially to like kind of dive into the sensitivities a bit more. Most of that upside is coming from what they call controllable costs, and these are one, the COGS inflection that should be coming due to pricing, lowered pricing, and then two, from some licensing issues that they have in Brazil. So there are a lot of other drivers here that are giving them substantial upside just because of even in the case of low single digit decline in prices at volume. There's so many other components to the business that are still giving a lot of upside. So that's the reason why we still see significant upside even with these low decline numbers.
Can you talk a little bit about the international acreage growth? I know you put some data points on sort of what Brazil and Argentina acreage growth look like. And I know the sell side, to your point, is extrapolating US-like growth. Like what over a longer time frame, like how much faster has international acreage growth been compared to the US? And I guess maybe just want to understand why that sort of the short term is right there and that it's outgrowing by a lot, given obviously population growth trends are a little bit different and there's sort of farm productivity growth, which to me it's not obvious why it grows much faster than the US, given how much the US exports, but would love to understand that a little bit better.
Yeah, I think that's a good point. So Brazil and Argentina, they're actually the biggest soybean producers in the world. They're a lot farther than the US. The US is good. They make a lot of corn, right? But for soybeans, they're probably third or fourth. The biggest countries that produce soybean is Brazil, Argentina, and then China. So that's the reason why LATAM is growing a lot faster than what the US acreage growth is currently growing at. And I think more importantly, it's just we're at this moment where the growth is complemented by this product cycle that's kind of shifting away from a single acting glyphosate and moving towards a dual acting thing. There's been a lot of studies, a lot of papers published within Argentina specifically about how glyphosate right now is just ineffective, not only because the weed resistance, but also because within LATAM, there's a lot of like pesticide risk as well. There are a lot of like locusts that have to be dealt with as well. So it's just like a mixed bag of like not only its growth strong, but also the older glyphosate is no longer effective anymore. So they have to pivot towards this newer product. And this is the short-term play. The long-term trend is just like it's just a better environment to grow soybeans in, because of the humid temperature and the climate.
Makes sense.
I guess I was curious, you guys use like an 11.8 times terminal DCF multiple, I think it was in slide 12. Why is that the right multiple?
Yeah, so I think we picked 11.8 times multiple because it was about the pre-COVID average. So I think before COVID, it was trading about like 13x. And then now recently traded down to like 11x. So we just kept the multiple the same, grew it out to 2027. Yeah, but it's also relatively in line with other peers. If you look at like other agroscience peers, it's similar around the low double digit multiple range. And we did do some sensitization with the WACC on exit multiple. So yeah, that's the main reason why we chose the 11.8x multiple.
And then in terms of the margin profile, you guys have, I'm looking at slide 11 to 12% net income margins. What's this business run at historically? Like it looks like that's like double what it's run at historically that I'm seeing, but I don't know if that maybe I'm wrong. I think this was a spin out, so I don't know what the history looks like further back.
Yeah, so if we pull up like the historical net income margin, it's about the same. So this company spun out of DuPont in 2019. And in 2022, they did about 680 million in net income. 2021 did about 1.7 billion. 2022 did about 1.2 billion. So it's still around the same range. The margin has been about it's been about like 6% during 2020 and about 13% or 14% in 2021. So it's about in the same range. There's just been it's just been like very hard to kind of find a normalized margin just because of the one just because of COVID pull forward, and that dynamic has yet to normalize. So we think this should be the normalized margin going forward.
Do you know what Bayer's margin looks like?
Yeah, unfortunately, Bayer doesn't disclose their agriculture margins just because they have so many other lines of business, right? They have pharma, they have um I think pharma is their biggest business line, so there really isn't an exact breakdown of like what the net income margin is for the agroscience side. Um, but it's a relatively high quality business. I think these margins should be around the same.
Thanks, guys.
Thanks, guys. This is great.
All right, so with that, our 2025 pitch competition comes to a close. Thank you once again, to our judges for being here and your comments and feedback. All our participants for your fantastic pitches, and of course the audience here on this live stream for supporting our event. So we'll send an email out with the results as soon as we decide on them, and the recording of the final round and the freshman showcase will be available on our YouTube channel in the days to come. And yeah, I mean, I think judges, once we hop off the Zoom, you could just please just jump on the invite that I sent you previously so we can discuss. But yeah, otherwise, thank you guys so much for watching, and see you again next year.